after the basic plan pays. Medical expense indemnity insurance is available in a variety of forms. This lesson explores the most common forms, their characteristics, and how they differ from major medical expense insurance. Basic medical expense indemnity policies. Basic medical expense insurance covers a specific form of medical care. These policies are the oldest form of medical expense insurance. As indemnity plans, they reimburse insureds for medical expenses. First dollar coverage. Basic medical expense plans pay claims on a first dollar basis. The insured does not pay a deductible or copayment amount. These policies reimburse all covered expenses up to the policy's maximum amount. There are 3 types of basic medical expense policies. Hospital expense insurance, surgical expense insurance, physician expense insurance. Basic hospital expense policies. Basic hospital expense policies cover hospital costs. These costs include daily hospital room and board charges and miscellaneous expenses, such as prescription drugs, x-rays, lab fees, dressings, and use of the operating room and supplies. These policies provide a maximum per day benefit for a certain number of days. Example: Marla's basic hospital expense policy pays a benefit of $200 per day for up to 30 days. Marla pays any hospital costs that exceed $200 in one day, and any hospital stay after the 30th day. Hospital expense policies also cover miscellaneous hospital charges. This coverage is limited to a multiple of the daily room and board limit, such as 20 times the daily benefit for hospital room and board, or a maximum dollar amount. Hospital expense policies do not cover physician services or surgeon fees. These costs are covered by a basic surgical expense or basic physician expense policy. Basic surgical expense policies. Basic surgical expense policies cover surgeons' fees and costs. These include fees for an assistant surgeon, anesthesiologist, or even the operating room if it is not covered as a miscellaneous hospital item. Early basic surgical expense policies had a fee schedule that ranked surgical procedures according to complexity. The more complex the procedure, the higher the ranking. Each procedure was assigned a unit value, and the maximum amount the insurer would pay for that procedure was based on its unit value. Due to their inflexibility, surgical fee schedules have been replaced by the usual, customary, and reasonable, UCR, charges method. Basic physician expense policies. Basic physician expense policies began by paying for doctor's visits while an insured was hospitalized. Coverage eventually expanded to include routine doctor's office visits, charges for diagnostic x-rays, laboratory charges. A basic physician expense policy specifies a maximum benefit per visit. It also specifies a maximum number of visits per injury or illness. Basic medical expense policy limitations. While basic hospital, surgical, and physician policies have some attractive features, such as first dollar coverage, these plans may pay only a small percentage of an insured's total costs. In addition, basic medical expense policies cannot control costs. Premiums can rise dramatically as claims costs increase. Worse, insureds who are seriously ill or injured often find the basic coverage inadequate to meet general health care needs or large health care costs. The insurance industry responded by developing major medical insurance coverage. Major medical insurance. Major medical insurance policies are indemnity plans that pay covered medical expenses beyond the limits of a basic medical expense plan. Through broad coverage and high benefit limits, major medical policies are better suited than basic policies for covering costly illnesses or injuries. In contrast to basic medical expense policies, major medical policies have high maximum lifetime benefits. These benefits range from $250,000 to $1 million or more. Some have no stated benefit limits. Many include a restoration of benefits provision that restores an insured's lifetime maximum benefit amount after a claim has been paid. Major medical policies cover a broad range of medical care and treatment. They usually exclude only cosmetic surgery, occupational injuries and illness, and routine vision and dental care. Major medical expense plans are available as A supplement to a basic plan, supplemental major medical. A comprehensive standalone plan, comprehensive major medical. Supplemental major medical coverage. Designed for use with a basic medical expense policy, a supplemental major medical policy covers expenses that the basic plan does not. Example: Alfonso's basic hospital plan pays for hospital room and board for up to 30 days. It pays a maximum benefit of $3,000. His supplemental major medical policy covers hospital room and board beyond the 30th day and any costs over $3,000. His supplemental policy also covers costs that the basic plan specifically excludes. Because the basic medical policy provides first dollar coverage, supplemental major medical policies have a high deductible. The basic policy will pay much of the initial costs of the medical care before the supplemental major medical policy pays expenses beyond the basic policy's limits. The high deductible avoids duplicate coverage and helps keep premiums low. Comprehensive major medical insurance. A comprehensive major medical policy has a broad range of coverage and eligible expenses. Unlike supplemental major medical policies, comprehensive major medical policies are independent plans. They are not combined with any other medical expense coverage. Major medical insurance policy features. In addition to broad coverage and high benefit limits, major medical plans have several distinct features. Deductibles. Coinsurance. Stop-loss limits. Exclusions for pre-existing conditions, only in major medical plans with grandfather status under the Affordable Care Act. Major medical deductibles. A deductible is an amount of money that the insured pays before a policy pays any benefits. Major medical policies have an annual deductible. Most of these policies include a family deductible, which is usually 2 or 3 times the individual deductible. When the sum of deductibles paid for all family members' claims equals or exceeds the family deductible, the insured pays no more deductibles for the remainder of that year. However, the insured may still need to make coinsurance payments until the annual out-of-pocket maximum limit is reached. After that, the insurer pays all covered claims for the rest of the year. Some policies have a per-cause deductible. This requires the insured to pay a deductible for each illness or accident. Deductibles can be either flat or quarter. Used with comprehensive major medical policies, a flat deductible is an amount the insured must pay before the policy pays benefits. Example: Hector's comprehensive major medical policy has a flat $500 deductible. He incurs $7,000 in covered medical expenses. Hector must pay $500 of the expenses. Then the policy will base how much benefit it pays on the remaining $6,500. Used only with supplemental major medical policies, a corridor deductible creates a corridor between the basic medical policy's benefits and the supplemental policy's benefits. This deductible applies after the basic plan pays benefits and before the supplemental plan pays benefits. Example: Genevieve has a basic hospital plan with a supplemental major medical plan. She is hospitalized and incurs $10,000 in expenses, which are covered by her 2 plans. The basic policy covers the first $3,000 of her costs. The supplemental plan has a $500 deductible. Please pause the audio and review the table. Carryover credit. Eligible health care expenses incurred in the last 3 months of a calendar year can be applied toward the deductible requirement of the next calendar year. This credit is applied even if the current year's deductible has not been met. Major medical coinsurance. In addition to deductibles, major medical policies have a coinsurance or copayment provision. This provision requires the insured to pay, in addition to the deductible, a certain percentage of the covered costs. This percentage is usually 20 or 30%. Then the policy pays the balance. So an 80-20 policy means that the insurer pays 80% of the cost and the insured pays 20%. Major medical stop-loss feature. Common to major medical policies is the stop-loss feature. This feature limits the annual dollar amount the insured pays for medical expenses under the policy. Stop-loss amounts vary by insurer and by policy but usually range from $2,000 to $5,000 a year. Once the insured's total deductibles and co-payments equal the stop-loss limit, the policy pays all other covered costs for that year. The higher the stop-loss limit, the lower the premium, all other factors being equal. So, the premium for a policy with a $5,000 stop-loss feature will be less than an identical policy covering the same insured with a $2,000 stop-loss feature. Pre-existing conditions. A pre-existing condition is an illness or medical condition that the insured had before the policy's effective date. For a long time, major medical policies excluded pre-existing conditions from coverage. The exclusion prevents adverse selection against the insurer by not covering medical costs associated with the condition. A pre-existing condition exclusion lasts for a specific period, such as 1 or 2 years. After that, the policy covers the condition. The ACA prohibits pre-existing condition exclusions in health insurance policies. All medical expense insurance policies issued since the law took effect in 2014 must accept applicants regardless of pre-existing conditions and cover these conditions as they would any other. For your review, basic medical expense plans pay claims on a first dollar basis, so the insured does not pay a deductible or copayment. Basic medical expense policies reimburse all covered expenses, up to the policy's maximum amount. Major medical insurance policies are indemnity plans. They pay covered medical expenses beyond the limits of a basic medical expense plan. Their broad coverage and high benefit limits make major medical policies better suited than basic medical expense policies to cover expensive illnesses or injuries. Major medical policies can be independent plans, comprehensive major medical, or they can supplement a basic medical expense policy, supplemental major medical. Used with comprehensive major medical policies, a flat deductible is an amount the insured pays before the policy pays benefits. Used only with supplemental major medical policies, a corridor deductible is an amount the insured pays after the basic plan pays benefits and before the supplemental plan pays its benefits. A pre-existing condition is an illness or medical condition that the insured had before the policy's effective date. Please pause the audio and watch the video. You can restart the audio.
To move ever more towards the managed care approach of providing expense insurance. The fact remains there are 2 basic types of indemnity policies sold today by commercial insurance companies, and they will continue to be sold into the foreseeable future. This lesson discusses those 2 different types, and I just want to take a moment to make sure you understand the basic difference between what we call basic medical expense insurance and major medical expense insurance. To understand basic major medical expense insurance, think of back the way it used to be when somebody going to the doctor was maybe a $20 deal. Back then, covering the cost of medical care was a very reasonable thing for a policy to do, and in fact, basic medical expense policies paid benefits on what we call a first dollar basis. You went to the doctor, you got paid, sent it to the insurance company paid the first $20, $25 of the cost. Anything over that, you're on the hook for. And that was fine, again, when the cost of medical care was much more reasonable than it is today. But of course, today, things have changed. The cost of medical care, even going to the doctor, is a very expensive proposition. And as the cost of medical care changed, so did the way the insurance industry approached indemnifying or reimbursing people for those. And that developed into the major medical policy. Major medical insurance is basically insurance that covers what we call costs that exceed a basic amount. In other words, the basic cost of medical care is paid by the insured in a major medical policy through the deductible. Costs that exceed the deductible are covered by the major medical policy. The 3 terms that you want to keep in mind and make sure you understand when you study major medical insurance are the deductible, which is a way of controlling costs. It's a first dollar cost of medical care that is a responsibility of the insured to pay. Coinsurance, which is another cost-sharing mechanism designed, again, to keep premiums reasonable. And coinsurance is the amount of care beyond the deductible that the insured is responsible for paying. And the third concept you want to make sure you understand is what we call the stop loss limit. Stop loss simply says once an insured's out-of-pocket expenses reach a certain point on a per-year basis, the policy picks up 100% of the costs exceeding that. And that's a reasonable thing to include in the policy, because if you think about it, today, even minor surgery can be very expensive, and if the insured had to pay 20%, let's say, of all that it costs, it itself could be a very devastating expense. So stop loss limits are intended to make sure that the insured isn't driven into the ground by the cost of even modest medical care.
Okay, so here are the 4 questions for this lesson. Which statement about a flat deductible on a major medical plan is correct? Which one is correct? Flat deductible is used in comprehensive major. Deductible is used in supplemental. A flat rate is the same as corridor deductible. A flat deductible is paid if the insurer pays the benefit. So I'm thinking it might be this one. All right, question 2. An insured's basic surgical expense policy fees schedule assigns arthroscopic surgery a unit value of 60. To determine the maximum benefit amount, a conversion factor of $20 is paid by the unit value. When the insured has arthroscopic surgery, the policy will pay a maximum benefit of All right, so let's look at this. To determine the maximum benefit amount, a conversion factor of $20 is paid. So I'm thinking it's 120, 60 times 20, right? Maximum conversion rate. All right, we'll go with that. I don't know if it's right or not. All right, which statement about the stop loss provision in a major medical policy is correct? It protects the insurer from adverse selection. It limits the insured's out-of-pocket expense. The lower its maximum limit, the lower the policy. Its maximum limit per loss is 10%. I want to say this one. I don't know if it's correct or not. We're going to find out in a few minutes. Which of the following is not characteristic of a major medical plan? Coverage of cosmetic surgery is my guess. All right, let's go and see how we did. We got 50 of them right. It was the last 2 we got right. Major medical plans do not cover cosmetic surgery. Which statement about the stop loss in a major medical policy is correct? It limits the insured's out-of-pocket expense in a year. All right, I wasn't sure about this one. Yeah, I was adding more on, wasn't I? 60 times 20 is 1,200. Let me say, just to make sure. I was doing that off the top of my head. Yep. Next time I need to pull out a calculator. So that's basic math there. All right, so a flat deductible is used in comprehensive major medical plans. That is the answer that is correct. Flat deductible is used in comprehensive major medical plans. All right, so a flat deductible is common, but they're not used with major medical plans. The insurer pays it before the insurer pays a percentage of the remaining expenses. In this case, with any type of deductible, the insurer pays it before the insurer pays a percentage of the remaining expenses. All right, so that's it on this lesson. Stay tuned for the next one, which will be managed care plans.